Let's get in a market perspective. Hemant Kanawala of Kotak Life Insurance is now joining us. Hemant, thank you so much for taking out time for us. Could you just tell us what's expected in terms of earnings for FY18 and the guidance that you have seen so far, or earnings that you have seen so far? Do you think that markets are, earnings are broadly in line?
So the earnings so far has been broadly in line. There have been some downgrades at the aggregate level, but nothing, major. But I think the key event to watch out in FY18 is the implementation of GST, and that is where the guidance from the companies are not yet clear. The tax rates for the GST have been announced, last week, and now we need to see how it will, play out in terms of inventory built up before the implementation of GST, and post that whether there is a market share gain by the listed players or not. So there is an uncertainty in that terms, but overall at the macro level, the outlook is positive. The effect of demonetization is behind us, and companies are seeing better demand scenario going forward. Even monsoon is expected to be on time and in line with the long-term average. So overall scenario looks better. But only uncertainty as of now is the implementation of GST, and that's the event we need to watch as it plays out.
But do you think that will be a disruptor, or whatever has been announced so far, there is nothing major in terms of earnings cuts or upgrades that would come in for the entire Nifty or the top 200 companies?
So it's definitely a long-term positive for the economy and the listed players. But what is not clear as of today now is that how will it play out in FY18. So one is in the June quarter, whether we'll see destocking happening by the wholesalers and distributors. So that is a first uncertainty. As of now, the indication there should not be, but we need to observe as the event plays out. And second will be, as I said, how will it play out between the listed and the unlisted players. So or the organized and the unorganized players. So we need to watch it out. There can be some uncertainty in the FY18, but looking beyond is definitely positive for the economy.
Right. Just in terms of market valuations compared to expectations of earnings growth, you think it's in line? So don't expect major returns from here on?
So, finally, market is a factor of both earnings and valuations. So earnings are coming in line with the expectations. So, it's fair to say that your return should be in line with the earnings growth. But what is also happening is that we are in a better situation globally also. And risk assets are doing well regionally as well as in the global context. And that may lead to some valuation relating also. So your returns can be possibly in excess of the earnings growth which we might see. But we need to keep in mind that after seeing a very slow earnings growth for the last 3 years, going forward as the economy picks up, it's possible that the earnings growth itself can be in double digit for a number of years. And then it's a fairly decent return even if the market gives you return in line with the earnings growth.
Right. Also, can you just tell us that, what happens when the base is low, earnings growth is high, and you have such changes in the tax rate? Do you think most probably, things go in the positive direction rather than negative?
So that's the assumption, and that's where, we believe that equity is a, preferred asset class today, because most of the macro situation is falling in place. Interest rates are low, inflation is low, government is consolidating the fiscal deficit very well, and it's committed towards it. And even on the external side, situation is looking very stable. So all the ingredients for a better economic outlook and hence better equity as asset class is there. Government is also encouraging savings in financial assets. So, which means both equity and debt. But since interest rates are low, we believe it will help equity as asset class in the medium term. So, with a 3 to 5 year view, equity definitely looks a better asset class today.
Recently, there has been a lot of correction in the mid-cap space. Are you surprised by it?
So, because of the sharp run-up we have seen since January, there was a belief that valuations had run up ahead of times in the near term, and that's where some of the players were looking for corrections to buy into them. So this correction is mainly is a reaction to the sharp run-up it has seen. So we are not really surprised, and looking at the flows in the domestic institution, we believe that such corrections will be bought into. It's difficult to say what levels, but there will be definitely buying emerging at lower levels in mid caps.
Do you think the valuations that India is in, the sweet spot that India is in, or one can say that domestics here are buying, but globally you only have FII numbers that are big. So do you think that India will be vulnerable to any any major global risk, because this is the only market where volumes are still high and domestics are ready to buy if FII want to sell?
So global risk always remain that we need to monitor. Like if you observe FY16, when FIs were selling globally, and even if you see after US presidential election, there was sell-off happening in the emerging markets. At both times, although domestic institutions were buyer, FIs sold and markets corrected with that. So we always need to keep eye on the FI flows for the near-term market reactions. And if there is any risk of happening globally, and FIs turn sellers, then it can produce corrections in the market. But the good news is that if we believe that economy is on the uptrend, then such corrections should be bought into. It offers an opportunity for domestic institutions to increase their equity holding in these companies.
Right. When you're saying that such corrections should be used to buy into, what essentially do you mean? How long should one wait for this correction? Or it has to be a stock-specific, data as to, whether it's the worst quarter for the company or the best quarter, and that's how the call has to be taken?
So there are no standard rules. That's where for a individual investor, if it's not on top of the companies, it's better to do a systematic investment, because one cannot say that whether correction will be 5% or 10%. At times the situation evolves and the correction happens. For the as far as the domestic institutional investors are concerned, whether they are well informed, they will take decisions after looking at the company's fundamentals, their results, whatever the public information is available, and they will take the call accordingly. So there cannot be any general rules that this is where you have to bought into. So for an individual investor who is not very well informed the market, the best strategy is to spread his investments over the time.
Right. Also, SIP, or if anybody wants to start a fresh SIP or is doing a SIP, really market valuation, market levels doesn't matter, because a time will come when market valuations will be subdued, and that's the time you will buy again?
That's true. That's the basic philosophy behind systemic investment, that you may believe market is run ahead of its time in the near term. It's possible. It is very difficult to put a fine value that whether this is a fair value or 5% lower is a value. So only because market is run up say 15-20% near term, you believe that it is heated up and it can correct. Otherwise, on a fair value basis, it's very difficult to justify whether this is right or only 5% lower is right, because it's very subjective. So that's where systematic investment helps. That if market falls lower, you end up buying more in terms of units, and that's where it helps in the longer run.
Right. Let's talk about some sectors. What's happening in pharma? Do you think it's getting in the attractive zone?
So valuations have corrected. Now, the expectations are setting lower. The key question is that what will lead to earnings growth coming back and again re-rating happening. And those triggers seems to be missing for the time being. But we always believe that pharma is a pretty bottom-up sector. You cannot look at all the companies with the same brush. We'll have to look at, because each companies can have different opportunities in the US market, because some can have more exposure to domestic market. So even when the pharma sector is under pressure, some of the companies have done well and are trading near their all-time high also. So we need to look at those opportunity. For the timing, it looks like that companies which are exposed to domestic market more and have more opportunity to grow in US market are better placed. But that is what the scenario is for the timing. It can change, but at the very broader level, for the larger companies, we don't see any reasons for outlook to change, and it may take some time to consolidate low levels before things start looking better for them.
Right, but do you think that pharma is a sector that you would want to look now, or with all the negative news flow that is coming now from US, from the rupee, from the domestic market, just stay away before things calm down, or at least news flow calm down?
So we constantly evaluate all the sectors, and so we are looking at various companies. But for the timing, we don't see any great reason to increase exposure to them, because apart from the business challenges, even currency is not helping them. And if FI flows continues this way, currency means US dollar can remain under pressure, and there is another headwind for the sector. So overall, we are evaluating it, but for the timing, we are not increasing exposure to the sector.
Right. In terms of IT, what is your call? Do you think IT has bottomed out? At least valuations definitely are nowhere compared to the pharma sector.
So that I agree. Again, IT is somewhat better placed because valuations are better. Companies are cash flow, rich. They have a lot of cash on the balance sheet, and some of the companies have also started returning capital aggressively to the shareholders. So that is another positive which is happening. So relatively it's better place. So if someone is looking as a value play and definitely with a longer term time horizon, IT looks better place. So it may not outperform the market in the next 3 to 6 months possible, but over the longer term, it can definitely give you good absolute returns because valuations are reasonable, and capital allocation is getting better for the companies.
Whenever the sector is not delivering numbers, or people don't want to own the sector, there'll always be that question mark on the sector. We've seen it time and again. It happened with metals earlier. It happened with some other sectors. But look at the valuations now, and you would be surprised.
So I agree with you. It's very difficult to time out because like when metals started correcting, they topped out in somewhere in 10, 11 and bottomed out in 16. At every point of time, you may have believed that it is good time to buy into metals because they have corrected 50%, but correction goes on further. So in trying to at times find out the bottom, you may end up investing early. So it has to be evaluated. So again, it comes down to how informed investor you are. So it's under evaluation, but we don't believe it's at the time to buy into them because from an outperformance point of view. So IT can give you absolute returns. There may not be much downside to the stocks, but sometimes as an institutional investor, you also look at which is the sectors which can outperform the market, and that is where we believe the challenge is. It may not outperform in the near term. Or longer term, as the scenario evolves, we need to take a further relook into it.
Right. In terms of IT and pharma, do you think they are great sectors to own, at least compared to disclosures for any other sector? These companies tend to give a lot of data versus what other sectors do.
I agree about IT, but not so much about pharma, because pharma is even disclosures cannot be complete. And it's a reasonably complicated sector to track for particularly for individual investor, because there are many drugs involved, and some of the terms they may not be very, very familiar with. So IT disclosures are pretty good, but same cannot be said about pharma because of the complications of the business. It's not that governance is an issue, but just the business overall is complicated. Every company, as I mentioned earlier, is unique in its own case. So we need to evaluate all of them differently. Like IT, broadly the same parameters impact each and every company. Although in particular period, some company can do better than others, but the macro factors impact all companies equally. The same is not true about pharma.
Hemant, what do you think looks good? You said corrections should be used as an opportunity to buy. So what is looking good to give returns in the near term, say in the next 12 months?
So we remain positive on discretionary consumption, mainly on two counts. One is we believe economy is on the rise, interest rates are lower, so these factors will help increase consumption of these items in India. Penetration of most of this compared to the even region is very, very low. So there is a potential for them to grow. So that is number one. And number two, as I mentioned earlier, that GST can be a good trigger for all these companies. So in FY18, there can be some uncertainty. But beyond that, we believe that organized players will gain market share because they are already tax compliant. They are well suited to adjust to the new environment. So overall, we believe discretionary consumption is a good place to be in. Second theme where we remain positive is private sector banks, both on the retail and corporate side. Retail continues to show good traction, but we believe that as we move into when we look beyond FY18 and into more into FY19, even the corporate banks will start looking good. And there the private sector banks have the capital, and they can leverage this opportunity in a better way. So private sector banks is another opportunity where we continue to like them.
All right. In case we have a good monsoon, would you also look at auto players? Do you think there's more room for them to go up, especially the two-wheelers?
So we like auto, and when we say auto, we classify it under discretionary consumption. So when we say consumption, it is three mainly: automobiles, consumer durables, and third is home improvement segment. Because all these three are reasonably focused area from the government point of view also. So, and low interest rates help automobile sales. So that's where we are positive on automobiles.
Within the automobiles, do you think you'll see uniform performance between the two-wheelers and the four-wheelers? Any preference between the two?
So valuations apart, if you look at the penetrations, then four-wheelers offers you better opportunity because the penetration levels are low, and as anyone moves up the curve, he will want to own a four-wheeler rather than a two-wheeler. So that way the potential is huge in four-wheeler, and for the listed players, even the competitive scenario today is better because the leader has almost 50% market share and continues to dominate, and you don't see high competitive intensity. So within two-wheelers, the challenge is one is penetration levels are high and competitive intensity is also high. So you will have to be one needs to be very, very selective when one buys into two-wheeler company, but they can offer you again absolute return from your point of view. So if someone is not looking at relative performance, they offer you good opportunity because they are free cash flow generating companies. You don't need high capex, and dividend payout is also good. So two-wheeler also looks good from absolute return point of view.
All right. What about other spaces like real estate and telecom? Do you think there also investors can make money?
So telecom, we are not sure as of now because competitive intensity remains high. So one of the parameter we use actively when deciding on a sector is the competitive intensity. Because if competition is high, then it is difficult for companies to make margins in that business. And so that is where we are somewhat cautious on that sector for the timing. It's under watch, but we need to see how the threat from Reliance Jio evolves. So that is where we are cautious for the sector. Real estate is an interesting opportunity because after the implementation of RERA, we need to see how each company evolves. So that is where again one needs to do more work. The balance sheet of many of the companies are under a lot of stress, which is reducing at the margin. So real estate can offer an interesting opportunity from a longer term point of view, but one will need to do more work on it, and we'll need to see how the companies evolve under RERA regime. So it's long term positive, but near term we need to still watch them.
Right. Just in terms of real estate, what do you think? You think prices of real estate will go up or volumes will go up?
So where the focus of the government is, and with the advent of a regulator, that is RERA, we believe that volume will have to be the focus of each and every company. Because if prices go up from here, affordability will again become an issue. So the companies which are focused on volumes, particularly affordable, and when we say affordable is not 10 lakhs, but will be geography specific. So say if you are talking of Mumbai, maybe less than crore. And if you're talking of maybe some of the other geographies, less than 50 lakhs. So specific to each geography, but which is affordable to middle class, those players will do well. So and many of the companies were not really oriented towards it in the last few years. They were moving more towards luxury housing. So companies will have to reorient that business model. It will improve more volumes and less on pricing. I think so those companies will do well.
Right. Just in terms of real estate, say, there have been some issues with real estate companies earlier regarding their debt, the way they take their revenue recognition, it takes some time, numbers are very lumpy. So if you want to play the real estate, is there any other way that you can play it?
So obviously one play will be housing finance companies, but valuation of some of the companies have really run ahead of the time, and so investor will have to be careful about that. Another segment will be home improvement. So this is one segment where we remain positive because as houses will get constructed, and particularly by betting on the volumes and not the pricing, it will create good demand for the home improvement segment, which is mainly tiles, electricals, and plywood and everything. So that segment we believe is a better way to play real estate theme, and investors who are more risk taking can look at real estate companies also.
Right. Just in terms of the mid-cap space, do you think there are a lot of sectors which are now emerging? So after the recent correction of 7-8% that you've seen in the sector, do you think that that sector has started to now look good? So there are a lot of select companies which will tend to do better from here on?
Yeah, so mid-caps, one of the worry was that run-up was sharp and valuations were looking expensive. So any corrections is always the welcome thing. So it does not change the outlook for the medium term. Companies are expected to do well. So whenever the interest rates are low and economies look on the uptrend, mid-caps will do better than the large cap because it favors smaller companies. So that way we believe that mid-cap continues to offer good opportunity. Obviously risk return is not as favorable as it was 3 years back because of the outperformance it has given since 2013. But still, mid-caps can continue to do better than large caps. So, overall, after the correction, one can look at mid-caps. That is the view we have.
Right. And also, till the time, inflows from domestic funds are high, you think mid-caps would get, attraction because FIIs prefer to own large cap names rather than mid-caps, but because, of certain companies that, DIIs can continuously meet, they can continuously track what they are doing, the valuations would slightly be higher?
I will agree with you that, when domestics get money, since they are able to track more companies and even the smaller companies, their ability to go and invest in mid-caps is higher. But, finally they will look at valuations. If they believe large caps are, more attractive, they will invest in large caps. Because most of the funds which domestic funds are getting is into diversified funds and not only into mid-cap funds. So they have the ability to invest in large caps also. So depending on their outlook, they will prefer large cap or mid cap where they see better return potential. But overall, their ability to track smaller companies is better. So they will prefer mid caps. But if the valuation looks more favorable for large caps, they may look at them also.
Right. Also, can you just tell us about inflow into insurance? So insurance space did not see much inflows, but in the last 6-8 months, you think there is a pickup over there? Products have changed. People have started to understand the sector and the product much better.
So overall, if you see insurance, the gross inflows have been there for quite some time. The challenge has been more from the surrender point of view because normally insurance is a fixed term product, unlike mutual fund, which is open-ended. When investors can redeem money any point of time, insurance normally investor comes with 5-year, 10-year view, and when that term gets over, they tend to take the money out. So looking at the run up in the market, some of the investors might be making good returns for the investment done in the last 5 years, and so that's where the challenge is. So surrender is an issue. And we believe that as we go into FY18, as surrender becomes lesser, overall we see better traction on the insurance side.